China has been accumulating gold, and there was a report by BMO, an analyst at Bank of Montreal, that said the numbers that they're giving us, and Russia too, are, we believe, way below what they are actually accumulating. Not to mention they're the largest producers of it in the world. You look at what's happening in Switzerland, the export numbers coming out of the refineries, massive amounts, all going to China and to Russia and to Saudi Arabia and to these countries that ironically are in the BRICS. You look at what's happening on the Shanghai Exchange. On the Shanghai Exchange, you see silver priced at roughly $3 an ounce higher, over $30 in China, and gold 70, 80 bucks higher. This is the arbitrage knob we've been talking about, slowly turning up the arbitrage. So the traders who have access to the LBMA, who have access to the COMEX and to the Shanghai Exchange, can purchase in the West and deliver in the East. So what I am getting at is that I truly do believe, and that's why I say it feels different this time, that there is a possibility that they have lost control, they being the West, of being able to suppress the price of gold with naked futures contracts. They realize, perhaps, I'm not sure on this, but it sure feels that way, that they realize naked shorting copious amounts of gold and silver when the rest of the world is not only massively accumulating it, as the central banks have been doing for the last 3 years at record levels, mind you, but that there are willing participants willing to pay huge premiums to the fictitious, if you will, Western paper price and take delivery of it in China. And by naked shorting, you're ending up, I guess, setting up an infrastructure as dumb as a mud wall in a rainstorm. Because if all of a sudden these countries continue to stand for delivery, continue, gimme, it can bankrupt a company.
Andy Schectman's recent analysis reveals a concerning trend in the global economy. Countries like China and Russia are quietly amassing gold reserves, potentially shaking the foundation of the established financial order. Reports from BMO analysts suggest that official figures vastly understate their actual accumulation, with Switzerland's significant gold exports corroborating this notion. This accumulation, coupled with price disparities between Western exchanges and Shanghai, hints at a growing arbitrage opportunity. Schectman suggests that this concerted effort to hoard gold may signal a loss of control by Western powers over gold prices, posing a significant threat to the current financial paradigm.
Go back to 1974 when President Ford made buying gold legal again. The day after he did that, the Chicago COMEX market opened up, the futures exchange. And if you look at it from the perspective of the government, who said, fine, we'll let the people buy gold, but we can't let gold get out of control, because gold is the antithesis of the system. Gold is the barometer by which we measure the health of a nation. Of their economy, of their currency. And so for a very, very long time, whether you're talking the London Gold Pool or any time after, it has been in the vested interests of the West to suppress the price of gold, to make the system seem stronger than it is, to support the illusion of a strong dollar, of a strong bond market, etc. And so the way that they did that was, I guess you could say, kind of smart. When you buy gold right now on COMEX, like as a dealer like myself, if you have $7,000 or $8,000 in your margin account, that's it, just in your margin account, you can control a 100-ounce gold contract. So in essence, it's money that you're not even paying. The trade itself is just a handful of dollars, $5, $8, $9, whatever for the trade. But the money in the margin account allows you to control the price of gold, 100 ounces per contract. And if the price keeps going up like it is here recently, you don't even have to pay any money. So the exchange came up with this idea, and that idea was, how about this? We will, instead of letting supply and demand fundamentals dictate the price of the market, where the more people who want to buy it, the higher the price goes, which is an inverse relation to the price of the dollar. Let's do it this way. Let's create paper contracts with massive rehypothecation, so that you have 1, 2, 3, 400 claims on every single contract because really very few people have ever stood for delivery. And when the exchanges were formulated, countries like China and India, these were third world countries. These were countries that did not have the ability to stand up to the West and to stand for delivery and to do all of these things. So the West got together, all of the Western central banks, and hey, look, you guys, we can suppress the price of gold with a huge amount of leverage. We'll rehypothecate the contracts. And so we will make believe, in essence, that the contract holder owns the gold, and the contract holder can make believe that he or she paid for it because they just have to have margin in their account. So the whole thing is just all make believe, but what it does is it allows the leverage of the COMEX with big pocket individuals to post large margin accounts and control copious amounts of metal. And if the leverage or if the margin never moves against them, in other words, the price doesn't fall down below the margin requirement, they never even have to pay for anything until they close out the account or take delivery. So it started to dawn on me that this is changing now. So why is it changing? It's changing because for 17 months in a row, China has been accumulating gold. And there was a report by BMO, an analyst at Bank of Montreal, that said the numbers that they're giving us, and Russia too, are, we believe, way below what they are actually accumulating. Not to mention they're the largest producers of it in the world. You look at what's happening in Switzerland, the export numbers coming out of the refineries, massive amounts, all going to China and to Russia and to Saudi Arabia and to these countries that ironically are in the BRICS. You look at what's happening on the Shanghai Exchange. On the Shanghai Exchange, you see silver priced at roughly $3 an ounce higher, over $30 in China, and gold 70, $80 higher. This is the arbitrage knob we've been talking about, slowly turning up the arbitrage so the traders who have access to the LBMA, who have access to the COMEX and to the Shanghai Exchange can purchase in the West and deliver in the East. So what I am getting at is that I truly do believe, and that's why I say it feels different this time, that there is a possibility that they have lost control, they being the West, of being able to suppress the price of gold with naked futures contracts. They realize, perhaps, I'm not sure on this, but it sure feels that way, that they realize naked shorting copious amounts of gold and silver when the rest of the world is not only massively accumulating it, as the central banks have been doing for the last 3 years at record levels, mind you, but that there are willing participants willing to pay huge premiums to the fictitious, if you will, Western paper price and take delivery of it in China. And by naked shorting, you're ending up, I guess, setting up an infrastructure as dumb as a mud wall in a rainstorm. Because if all of a sudden these countries continue to stand for delivery, continue, gimme, it can bankrupt a company. And if
Continuing the discussion, Andy Schectman emphasizes the changing dynamics in the global economy. Reflecting on discussions with Bart Chilton, who revealed the impact of silver's surge on Bear Stearns' bankruptcy, Schectman suggests a paradigm shift. Historically, the COMEX market has controlled physical markets through leverage, but with rising industrialization and wealth in countries like China and Russia, this dynamic is evolving. These nations prioritize gold accumulation, unconstrained by traditional financial metrics. With mounting debt, bond market struggles, and rising interest rates, Schectman argues that gold's significance is resurging. He contends that recent anomalies in gold and silver prices signal a loss of control by Western powers over commodities.
If you don't believe that, just go back and listen to Chris Marcus's podcast with Bart Chilton, who admitted a week before he died that Bear Stearns went bankrupt because of silver going to $21 an ounce from $9, because they had such a massive short position. It bankrupted them. So I guess what I'm simply saying is this. For my entire career, my entire life, the COMEX market has controlled the physical market. The paper market has controlled the physical market because of the leverage and because of the fact that very, 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 very few, less than 1% of all contracts issued stood for delivery. Now, in a world where we see massive industrialization and wealth in the countries that are accumulating it all, like China, like Russia, like Saudi Arabia, like all the countries in the Middle East, like all of the countries in the BRICS that are growing in their wealth and in their middle class and in their industrialization. It's a different world. And they know that gold is remonetizing. They don't care about the relationship between real interest rates and the price of gold. They don't care about the strong dollar. They don't care about any of this stuff. They don't care about these correlations, right? They just want the gold. And they don't care about technical analysis. They want the gold because gold is being remonetized all around the world. What is gold? Oh, that's right. It's the only other tier one asset in the world. Who's been buying it all? Oh, that's right. All of the central banks. And so they don't care about the traditional relationships, if you will, where, well, the dollar's going up and real interest rates are going up, so we should sell gold. No, they don't care because they know in a world where the world reserve currency has been weaponized, and you have Janet Yellen going all around the world talking about confiscation of the $380 billion in Forex reserves of the Russians. We're going to confiscate it to fund the Ukrainian effort. Why the hell would anyone trust us? They won't. Not to mention, we've chosen inflation over austerity. We're accumulating $1 trillion in debt every 3 months right now, and our bond market has been a disaster. So my feeling is that as rates have gone higher, which is typically bad for gold, it's not. It's bullish for gold. Why? Because in this environment, to me, what the rising interest rates symbolize is the rest of the world not wanting to buy our bonds, which will ultimately lead to monetization by the Fed. They will have no choice but to come in and backstop buying up all of the treasuries that no one else wants to buy. And all roads lead to the same place. And so I guess what I'm simply trying to say to you is that I believe there is a fairly decent chance. Now, it's almost foolhardy to say this. It's taken a big risk to say it because it's never been this way, but it almost feels like they have lost the ability to control the paper price of the commodities. Now, take another step back. What did China buy a few years ago? Oh, yeah, the LME, the London Metals Exchange, which is basically all the base metals, right? So it's not just precious metals. Have you noticed what copper's been doing? They're buying up all of the metals of the base metals like copper and rare earth metals like nickel and zinc and aluminum and everything. All the soft commodities like wheat and soybeans and corn. This is what Zoltan Pozsar said was going to happen. It's impossible to make any strategic planning for economic development if you do not control prices of basic commodities. Price formation with this new currency should get rid of the Western exchanges of commodities. They know that we have been suppressing the price. They have been using this. I've been saying it over and over and over again. They have been using the suppression against us and taking delivery, draining the exchanges, massively draining the exchanges all around the world. You and I started talking about that in 2020 with the rise of the others, which are the sovereign wealth funds primarily. They are draining the exchanges. So they've gotten to the point where it's becoming harder to do that. And then they went to exchange for physical, where they buy contracts in the West, move them to the LBMA, and take possession of it there. That's getting harder to do. So what do now? They turn up the arbitrage sheet and say, we'll pay over $3 an ounce more for your silver and 70, 80 more for your gold for now. Maybe it goes higher. But what I want people to understand is that if I were being completely forthright with a gun to my head and someone said, you tell me right now, man, is it different this time? And it feels different to me. It really, truly feels like they've lost the ability, at least with gold, to hold it back. Now, there is a 90% correlation throughout all of human history between gold and silver. And silver will come along for the ride. But in 3 weeks' time to see gold up over $200, almost $250, Dunnigan, that doesn't happen. And to see it close the way it did on a Friday night, that doesn't happen. To see silver open up yesterday morning 7% and trigger limit stops in China, that doesn't happen. Something is different. And I think the mechanism that was designed to control the prices of commodities worked in a world where the West ran supreme. But all of a sudden, lo and behold, the rest of the world has gained sophistication. They have gained wealth, and they have gained the ability to challenge the West on a financial status, and at least in terms of the commodities that are being suppressed, and stand for delivery. It's changed everything. And I feel that something's different.
In today's discussion, we explored the historical context of gold manipulation and its current implications in the global economy. Andy Schectman highlighted President Ford's pivotal decision in 1974, which set the stage for controlling gold prices. We examined how Western powers utilized various mechanisms to suppress gold prices, while countries like China and Russia are amassing gold reserves. Schectman's insights suggest a potential shift in gold price control, with significant implications. Thank you for joining us.